$10 billion for private jets. Apollo is literally flying high with this Atlantic Aviation rumor.
Spare me the banker puns. KKR selling to Apollo is just private equity passing the parcel. They have $2 trillion in dry powder to burn.
Passing the parcel? It proves the Megadeal is back. Deal volume dropped 19%, but values just crossed $1 trillion.
Only because mid-sized buyers are boxed out by financing. But fine, convince me why Apollo wants to park $10 billion on a tarmac. The rundown. Talk about a K-shaped recovery. Deal volume is down 19%, the lowest since 2015, but values are up 35%. We just passed the $1 trillion mark for Q1.
The Megadeal is back, and the mid-market guys are just sitting on their hands, totally boxed out by the financing hurdles.
Speaking of megadeals, did you see McCormick combining with Unilever's foods business?
Oh yeah, they are building a $20 billion flavor empire, absolute global domination of the spice rack.
They keep saying synergies in the press release, but I want to see the actual integration plan. Unilever's food margins have been dragging for years.
Oh, the big one. $10 billion for private jet parking lots. That's the big one this week.
It's a little more complex than parking lots, Nate. Atlantic Aviation does fueling, maintenance, hangar space, concierge services. But yes, Apollo handing KKR $10 billion for it is a massive statement.
It's the ultimate sponsor-to-sponsor pass. I absolutely love this deal. It's pure infrastructure disguised as luxury. High net worth individuals aren't going to stop flying private. And there's only so much tarmac at Teterboro.
I'm not arguing the quality of the asset. I'm looking at the macro data. This is the exact definition of the K-shaped recovery we're seeing in Q1.
You're talking about the volume versus value split.
Exactly. Overall deal volume is actually down 19%. We're at the lowest number of total transactions since 2015. But deal value? Up 35%. We just blew past the $1 trillion mark.
Because the middle market is completely frozen?
Right. If you're a mid-sized buyer right now, the financing hurdles are an absolute nightmare. The rumor mill is full of stories about mid-tier sponsors getting completely boxed out by debt costs.
Which leaves the Titans. Apollo and their peers are sitting on an estimated $2 trillion in dry powder. $2 trillion. The limited partners are calling. The clock is ticking. You have to deploy it. So you write a $10 billion check for Atlantic Aviation.
But are they actually creating value here, or just trading it? This is my fundamental issue with these massive secondary buyouts. KKR marks it up, Apollo buys it, they'll hold it for 4 years, maybe roll up a few regional hangars, and sell it to Blackstone. It feels like a very expensive game of hot potato.
Oh, come on. That's just how the game is played. You buy, you optimize, you exit. It's a beautiful cycle.
Optimize what? The cost of peanuts in the VIP lounge? I read through the sector reports. The margins are already squeezed tight. Apollo is paying a premium just to put money to work because they're desperate to deploy.
I strongly disagree. Apollo sees a real estate play here. These fixed-base operators own long-term leases at major airports. That's a massive moat. You can't just build a competing private terminal at LAX. It's a monopoly asset.
A $10 billion monopoly asset. Fine. I'll concede that the barrier to entry is high. You can't exactly print new airport land, but I still think they're overpaying just to clear their capital backlog.
Spoken like a true skeptic. But hey, if you want to talk about paying a premium for a very specific, hard-to-build asset, we should probably look at what's happening in the rare disease space.
Oh, you mean Biogen handing over $5.6 billion in all cash for Apellis Pharmaceuticals?
$41 a share. Voices. I keep seeing this phrase floating around the analyst notes this morning. A K-shaped M&A recovery.
I hate it. It is just banker poetry to mask what is actually happening.
Oh, come on. It perfectly describes the quarter. Deal volumes are down 19%. That is the lowest we have seen since 2015. But the total deal value? Up 35%, blowing right past the $1 trillion mark. The big guys are doing massive mega deals, and the middle market is totally boxed out by financing hurdles.
Sure, the math works on the big numbers, But then you read these industry insiders claiming everyone is shifting to, quote, capability-driven acquisitions. They are trying to say buyers only care about hard-to-build AI infrastructure and specialized talent now instead of just grabbing market share.
Because they are. Look at everyone scrambling for data resources.
Nate, please. When a private equity titan drops $10 billion, they want market share. You do not deploy that kind of dry powder just to acqui-hire some engineers. It is a pure consolidation play dressed up as an innovation strategy.
Okay, but what about the divestitures? If it is just about getting bigger and grabbing share, explain the MasterCard rumor.
The Nets spin-off?
Exactly. Word on the street is MasterCard is quietly shopping around its real-time payments unit. They bought that from Nets for $3.2 billion back in 2019. Now they are trying to dump it so they can pivot hard towards stablecoin infrastructure and blockchain. That is a pure capability shift.
Or they just overpaid in 2019 and want to offload a low-margin business while crypto is having another moment. I need to see the actual prospectus they are sending around before I buy this grand pivot narrative.
Classic Maya. Absolutely no romance, just footnotes.
Romance does not pay out a premium to shareholders.
Fair enough. We will see if the regulators have any romance left in them tomorrow. We are watching for definitive filings on Otsuka Pharmaceuticals' $1.2 billion play for Transcend Therapeutics.
Plus, we need to see if the antitrust watchdogs start biting on any of these massive cross-border tie-ups. Spill the tea.
So the word on the street is MasterCard is quietly shopping around its real-time payments unit.
Quietly? Half the bankers in Manhattan have that pitch deck in their inbox right now.
True, but think about the timing. They bought that unit from Nets back in 2019 for what, $3.2 billion?
$3.2 billion, exactly. And now they're suddenly pivoting to stablecoin infrastructure. Call me crazy, but whenever a legacy payments giant says they're focusing on blockchain, I immediately assume they just want to dump an underperforming asset and need a futuristic excuse.
Oh, come on, that's so cynical.
I prefer data-driven. I read the footnotes, Nate.
Look at the broader market right now. We're in this brutal K-shaped recovery. Companies are shedding anything that isn't a core capability to free up cash. They want hard-to-build AI. They want specialized data. Simple market share grabs are dead. MasterCard is just trimming the fat to play in the new sandbox.
Trimming a $3 billion piece of fat. Sure, but you're right about the K-shaped trend. Deal volumes are actually down 19%. It's the lowest activity level we've seen since 2015.
Exactly. Mid-market deals are completely frozen. The financing hurdles are boxing everyone out except the absolute heavyweights. Mid-tier sponsors are practically crying into their Patagonia vests right now because they can't get a loan approved.
But while the little guys are boxed out, deal values are up 35%. We just crossed the $1 trillion mark for the quarter.
Because the mega deal is back, baby. The big players are just eating each other. It's all massive consolidations and sponsors finally deploying that dry powder.
Which perfectly explains why a certain private equity titan is suddenly throwing $10 billion at private jets.
Oh, we absolutely have to talk about that Apollo deal. Tomorrow's radar.
I'm setting an alert for tomorrow morning. We should finally get the Otsuka filings on that $1.2 billion Transcend Therapeutics deal.
You actually think that gets done? Regulators are scrutinizing every cross-border move. I bet we see antitrust pushback.
It's clinical stage biotech, Nate. They're buying pipeline, not market share. Washington cares about rail tie-ups, not a target with zero commercial revenue.
Fair. Did you hear the MasterCard whisper, though?
Shopping their real-time payments unit?
Yes, the one they bought for $3.2 billion back in 2019. Now they want to dump it for stablecoin infrastructure.
Wait, really? Stablecoins? That's hilarious. They spent $3 billion just to realize crypto was the actual threat.
It's the ultimate K-shaped market right now. Volumes are down 19%, but total deal value just crossed $1 trillion. You're either doing a mega deal or selling off your old toys.
I need the footnotes on that MasterCard pitch deck immediately. Keep your terminal open tomorrow.